All right, welcome. Today, we're basically drawing a new map, not of countries, but of capital. We're diving deep into the world of alternative markets to figure out where the smartest money on the planet, trillions of dollars, is moving next. Let's get right into it.
Okay, so here's the big question we're trying to answer. We're talking about something called patient capital. Now, this isn't the fast, jumpy money you see in the stock market. No, this is the massive, slow-moving river of cash from pension funds and insurance companies. This is money that has to find stable, long-term growth for decades to come. And where it goes? Well, the global economy tends to follow.
So our journey today is going to have three main stops. First, we're following the search for new, explosive growth. Then, we're going to track the hunt for stability. We're talking about massive, real-world assets you can actually touch. And finally, we'll look at this fascinating trend where the market's gotten so huge, it has to start investing in its own plumbing just to keep things flowing.
Our first stop takes us east. You know, for years, all the chatter about big private equity deals was focused on the US and Europe, but that's changing. Right now, the hunt for the next big wave of growth is leading some of the heaviest hitters to Asia, and they are bringing their A game with them.
And that brings us to our first big number, $930 million. And look, this isn't just some random figure. This represents a massive strategic bet placed by a Swedish private equity powerhouse called EQT. And they're pointing all that firepower directly at South Korea.
So what exactly did that mountain of cash get them? Well, EQT snapped up a major stake in a company called Donzone Bison. They're a leader in South Korea in a very specific and very valuable type of software that is pretty much essential for any modern business to run.
And that software is called Enterprise Resource Planning, or ERP. The analogy here is perfect. ERP is literally the central nervous system of a company. It's the deep, complex software that handles everything. Finance, HR, you name it. And this makes it a classic private equity target for one simple reason. Its customers are incredibly sticky. I mean, once a company builds its entire operation on your system, it's almost impossible for them to leave.
So why Korea and not Silicon Valley? This slide lays out the strategy perfectly. The US software market is just crowded. Valuations are through the roof, and the competition is absolutely fierce. By pivoting to Asia, EQT finds a strong, local champion in a market that's still got tons of room to grow. They get to sidestep that bidding war back west and tap into a whole new wave of digital transformation. It's a pretty brilliant move.
All right, let's switch gears completely for our second destination. If that first stop was all about chasing dynamic growth in the digital world, this next one is, well, it's the exact opposite. This is about finding long-term, predictable stability by investing in massive, real-world physical assets. And whoa, the numbers here just get way, way bigger. $6.5 billion. This is a monumental commitment from one of the biggest names in the game, Apollo Global Management, and it's a huge bet on the future of green energy. And check this out. This is what they're investing in. It's not a company, it's a 50% stake in a colossal piece of infrastructure, the Horns of 3 wind farm. We're talking about a project so enormous it can power over 3 million homes. This is about building the literal power grid of tomorrow. Now this is where it gets really clever. How are they paying for this thing? Apollo is taking the classic playbook from leveraged buyouts, the LBO, and applying it to infrastructure. They use debt to help finance the purchase of a super stable asset, that wind farm, which then generates predictable, long-term cash from guaranteed energy contracts. It's a match made in heaven.
And what you get from all this is something the industry calls bond-like returns. What does that really mean? Well, it means the income is incredibly predictable, almost like a utility bill, and it's often protected against inflation. So for the managers of that patient capital we talked about, those insurance and retirement funds, this kind of stable, decades-long cash flow is absolute gold.
Okay, for our third and final stop on this tour, things are about to get, well, a little meta. The world of private capital has ballooned to such an enormous size that it now needs to invest in itself, in strengthening its own underlying systems, the market plumbing that lets these trillions of dollars move around.
So let's just lay out who's who here. First, you have State Street. They are a titan of traditional finance. Think of them as the ones who provide the essential plumbing for trillions of dollars in assets. Well, they just made a major investment in Kohler Capital, who happens to be a world leader in a very specific, very important niche.
And that niche is the secondaries market. So what the heck is that? You know how private equity is famous for locking up your money for like 10 years? Well, the secondaries market is basically the escape hatch. It's a marketplace that lets an early investor sell their locked-up stake to someone else, providing a vital dose of liquidity in a market that's normally really illiquid.
So why should we care about this deal? Because the signal it sends is absolutely huge. It shows that the old wall between traditional finance and the world of these alternative assets is just crumbling down. State Street's investment is a massive institutional stamp of approval. It's a sign that private capital isn't a niche thing anymore. It's a permanent, vital part of the global financial system, and it's here to stay.
Okay, so we've been to Asia for growth, we've seen giant wind farms getting built, and we've even looked at the plumbing of the system. Now it's time to pull back, look at the whole map, and see what this all tells us about the big picture strategy.
What you start to see is this clear three-pronged strategy taking shape. You have one arm of capital chasing growth in new, dynamic markets like Asia. At the same time, another arm is patiently building the stable, green infrastructure of the future. And a third arm is fortifying the market's own foundation to support all of this activity. It's a really smart play for growth, stability, and maturity.
And this all bubbles up to one massive question, which is captured perfectly right here in this quote. Is this move into Asia just a one-off, or does it signal a much bigger, broader pivot of global capital away from the expensive, crowded markets in the West? Honestly, the success of these early deals will probably decide the answer.
So when we wrap all this up, here's the real takeaway. Tracking these massive capital flows is like getting a sneak peek at the economic map of the future. The bets being placed today, whether it's on software in Seoul or wind farms in the North Sea, are literally drawing the borders of tomorrow's economy. And that leaves us with one final thought to chew on. What's going to be the next destination on that map?